The discount rate has two important definitions. First, a discount rate is part of the calculation of present value when doing a discounted cash flow analysis. And second, the discount rate is the interest rate that the Federal Reserve charges on loans given to banks through the Fed's discount window loan process. The first definition of discount rate is a critical component of the discounted cash flow calculation. For example, let's say a company has been in business for over 100 years, has considerable and consistent market share in its industry, and while consistently profitable, doesn't have the opportunity for significant growth. The company is stable, consistent, and predictable. If we can forecast the company's earnings out into the future, we can use the discounted cash flow to estimate what the company's valuation should be today. Unfortunately, this process is not as simple as just adding up the cash flow numbers and coming to a value. That's where the discount rate comes into the picture. Calculating what discount rate to use in your discounted cash flow calculation is no easy choice. The weighted average cost of capital is one of the better concrete methods and a great place to start, but even that won't give you the perfect discount rate for every situation. Understanding that the discount rate is an educated guess and not a scientific certainty, we can still move forward with the calculation and obtain an estimate of this company's value. The other important definition of the discount rate is the interest rate charged to a financial institution when they borrow money from the Federal Reserve discount window's lending facility. The discount window allows banks to borrow money for very short-term operating needs. These loans are typically extended for 24 hours or less. The interest rate charged is determined individually by each of the Federal Reserve banks, but is centrally reviewed and determined by the Board of Governors of the Federal Reserve System. Generally, the discount rate will be the same across all the Federal Reserve banks, except for the days around the time the discount rate changes. The discount window actually offers 3 different loan programs, each with its own discount rate. The primary credit program is the Fed's main lending program for eligible banks in generally sound financial condition. The discount rate on these loans is typically set above the existing market interest rates. The secondary credit program is available to financial institutions that are not eligible for the primary credit program, but still require short-term loans to fund short-term needs or to resolve severe financial difficulties. The third program is a seasonal credit program, available to smaller financial institutions with recurring fluctuations in their cash flow. A common example are agricultural banks, whose loan and deposit balances fluctuate each year with various growing seasons. This is an overview of discount rate.